Half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Yvonne then with David Ingles.
Let's get to your top stories today. China's economy facing fresh headwinds with a gauge of bank loans contracting here for the first time in almost 2 decades. Now, stocks across the Asia Pacific on the up ahead of some crucial US CPI numbers, of course, after factory inflation numbers backing the case for a Fed cuts in September. And speaking of cuts, a potential one out of the RBNZ, its policy call comes through shortly. Plus, Bloomberg reveals the U.S. Justice Department is considering a rare bid to break up Google after a landmark antitrust ruling.
Well, it seems like we get a bit of a lead here from the U.S. and continue to see equity markets are edging higher here this morning thanks to that softer PPI print that we got out of the U.S. So does that bode well for a US CPI print? That certainly is going to be the next hurdle on this Wednesday morning as you count down to that data print. And will it cement that September cut from the Fed? You take a look at what's going on. We're seeing stocks are bid up here by 0.8% for MXAP, Nikkei. You're seeing Taiwan's coming back online. And really, the market reaction yesterday was to basically buy bonds, buy tech stocks, and sell the dollar, right? So you're seeing that filter through in the Asia session. TAIEX is actually up about 1% here this morning. Treasuries are hovering around some of the lows in terms of yields here this morning. But right now, we're counting down, of course, to UK inflation coming out, as well as we're watching sterling at 128 levels, I believe I see on my screen, 147 for dollar yen here right now. And we're watching also very closely gold, not catching a bid here this morning, just given a bit of risk being put back on the table here. But ANZ had a pretty interesting line. They raised their year-end target to 25.50 for gold. Said gold will benefit from a strategic investment from a Fed pivot if it begins cutting rates as well. You take a look on the risk radar and what we're tracking as well. There's an RBNZ decision. So certainly what we saw in the Bloomberg Dollar Index was interesting. We're hovering near those sort of 4-month lows here right now. There you go. Taiwan Semi is seeing upside there this morning. Kiwi dollar, we're hovering around those 1-month highs, just given that downturn in the dollar of late here. So, ahead of this RBNZ decision, which is basically kind of a toss-up at this point of what the central bank is going to do. 14 out of 23 analysts polled by Bloomberg are forecasting a hold. The rest, maybe we might see a cut here today. So you're seeing some upside here when it comes to the Kiwi leading up to that, and Bitcoin catching a slight bid here this morning. The approach to the open is looking like this here. So as we got to talk about that poor data out of China, the credit data, the bank loan situation, and the like, and why domestic demand is so weak. Is that going to be another sort of headwind for Chinese stocks when we see turnover basically back to those pre-COVID lows there? There doesn't seem to be that much appetite, Dave, for this equity market at a time when you continue to see this crackdown in the bond market.
Yeah, I mean, the turnover that you mentioned onshore, so you combine everything, Shanghai, Shenzhen, and all the other sort of smaller benchmarks, 60 to 70 billion US dollars.
Yeah.
Nvidia, one stock, 39 billion. That's the biggest stock as well. So an entire market. It's really come down in terms of price. We've also come down quite slowly, but substantially if you measure that from the peak, of course, on onshore benchmark. But here's the silver lining, though. Offshore in Hong Kong, so we're up 4 days in Asia, we're up 5 days in Hong Kong. And we managed to put together a string of gains that have managed to push some of these momentum indicators. I guess in many cases, you look at some of them later on, we'll show you those signaling that we could see a buy signal right now. A lot will depend, of course, on not just the data. It's a big week for earnings, so Tencent, what they report, what they say about the buyback, what they say in terms of guidance moving forward, and that takes us then into Jingdong and Alibaba after a couple of days. A couple of auctions today. I think you have 2025, 2027, 2031, and 2044 bonds that are being auctioned out, roughly 400 billion RMB in terms of the size of the hitting the markets today. We are still in the window for FDA numbers to come through at any point today. But yeah, as Yvonne is pointing out, in terms of the data point, it was really this very weak credit number, which came out, I think, late yesterday.
Yeah, let's break it down a little bit more. China's bank loans to the real economy have contracted for the first time in nearly 2 decades, and it does mark a grim milestone that underscores weak domestic demand as a major hurdle to growth and recovery. For more, let's bring in our China correspondent, Min Min Lo. How bad were these numbers, Min Min?
Yeah, well, the last time we saw a contraction was in July 2005. So this time, the new loans for the real economy was down 77 billion yuan. So that's a classic sign of balance sheet recession. It means that households and businesses are paying back more debt than they are taking out. Especially for households, new loans are down by 220 over billion yuan, and they are cutting down on short-term borrowing. They're cutting down on mortgages amid that housing downturn, and they are paying back more of their debt. When it comes to businesses, in the non-financial sector, they are borrowing 150 billion yuan. That is the weakest print we have seen since October of 2019. So there's increasingly this fear that China could be following in the footsteps of the Japanese economy with, years of deflation, stagnation that is at the root cause of businesses and households refraining from spending. For China's case, though the debt level among households and businesses is still stable, no sign of rapid contraction yet, but you have interest rates remaining quite elevated if you consider the very weak inflation numbers that we're seeing.
So that is one specific metric. What about the overall number, the total social financing?
Yeah, the aggregate financing was disappointing as well. It came in at over 700 billion yuan. The expectation was 1 trillion yuan. So again, part of it is seasonal factors because in July, banks are not in a rush to give out loans to hit their quarterly target. And also you have the government cracking down on the so-called fake loans for financial arbitrage, which is a practice where companies take out cheap loans and they park it in the banks for high yield deposits. But also bear in mind, a big part of the aggregate financing also came from government financing, which accelerated for the third consecutive months. And that's where we see government financing continuing to push up new aggregate financing for the rest of the year, especially because we don't think, even with PBOC cutting rates in the last quarter, it's not likely to do enough to boost domestic demand.
Min, thank you so much. Min Lo, our China correspondent there. That's one big story we're tracking. The other one is, of course, U.S. inflation. Comes out just under 12 hours from now. Consensus is, when you look at these forecasts, year-on-year for July, at about 3%. That's matching the previous month, although certainly it's the sequential numbers, how much better are the numbers getting compared to the previous month? The month-on-month numbers on your screens as well. In terms of core CPI, we're looking at about a number of about plus 0.2%. Month on month. Now, just in terms of Fed pricing right now, we're looking at about 1.5 rate, 25 basis point rate cuts priced for September 17, 18. That's when the Fed meeting is. So it's effectively at this point a coin toss between a normal size cut and a fairly larger one, of course, at 50 basis points. As Yvonne is pointing out, yields have been pushing lower. The question of the day we have right now for our viewers is, at what point do we get to 3%? On the 2-year yield?
Yeah, I mean, we've already gone, 90 basis points lower in the past 3 months for the U.S. 2-year yield. Certainly, there's been a massive repricing on what the Fed's going to do in the bond market and really those recession risks and the like. Let's bring in Hebe Chen, market analyst at IG. How are you looking ahead of this U.S. inflation print, Hebe? Because obviously the PPI print was softer and really kind of bode well for this global rebound. Do you think that this US CPI print is going to further those gains?
Good morning, Yvonne. Good morning, David. Well, I think today's CPI is actually quite an interesting one. What I call it, they actually carry a dual mandate because this is the first consumer price indicator after Fed saying that they are returning to the dual mandate of looking at the price point as well as job point. And we're already seeing the market's been respond quite seriously to the recent job data. Now coming back to the consumer prices, as you just touched on, I think the expectation there is that inflation will be unchanged at 3% annually, core inflation likely to slowing down a little bit. But I think that minor surprise from both sides will only getting more support into either 25 or 50 basis point, which market sees the cut is not done deal now. But what we haven't seen, what we're not sure is if there's a big surprise there. For instance, if the cooling of the inflation is much larger than what we anticipated, will market take it as a more reason for 50 basis point, even higher, with much more cut, or we're taking as an early sign of a troubled economy? I think that's a quite interesting point that we could, and I'm pretty keen to get by the end of the day.
Right, and Hebe, we have about 12 hours to the data point. We had a rally in the U.S. Would you recommend adding to risk in this Asian session ahead of that CPI print?
Well, I think that as we just touched on the CPI today, potentially will only help the market to price in a more cut, either 25 basis point. What the rally in the US market yesterday, also in the Asian market yesterday, to showing that the confidence has restored there. But there's one thing I'm actually a bit concerned about, just looking back the past 2 weeks, is that I do see quite a swinging sentiment. The market seems to rush into price in any possibility in a quite a eye-widening speed. I think that's a big uncertainty there, whether or not the market will take in the inflation data in the weight of that. Potentially, is the economy will back into the worry about recession, and that's the biggest risk there. For the Asian trading, I think that we do see quite a positive sentiment carrying from the early this week, but I think there's a big surprise there that we definitely have to be aware of. And for the investors, it's probably not the good timing to all in at this stage, just in my opinion.
Okay, yeah. Can you talk a little bit more about the sort of divergence you're seeing across assets, right? Bond markets seem to be pricing in the risk of a recession is higher now. I'm not quite seeing that when it comes to equity markets or even credit here right now. What's the sort of narrative that you still subscribe to?
Well, yes, I think that last 2 job data is a quite strong indicator. So about a couple of months ago, we're looking at the job data. We prefer that it's a weak one. We're taking the bad news as a good news now. But it's not the case anymore. We do think the market seems to changing the lens for that. And whether or not that could broadening out to the other economy data, for example, retail sales, industrial production, anything that could potentially changing the lens of the looking at the data and the interpretation into the economy. I think that's a shifting change there. And again, I think that as fast as they change, the more risk for the market or the investor to misinterpret the data, to making a misjudgment for that, the risk for that is definitely will be higher. And that's the new norm, unfortunately, probably the thing that we have to comes to terms with as we get into the rate cut journey, as we get into the second half of the year. We probably were seeing the economy will slow down a little bit more.
Yeah, and on top of, Hebe, as you know, on top of the debate around how big the Fed should cut rates at its next meeting, there are 2 other things taking place, right? There's this unwind of AI, and there's also the unwind of the carry in terms of dollar yen, I think is a poster child for that. On dollar yen, what do you think the risk is right now as far as that exchange rate is concerned?
Well, I think from my point, I think either from the technical wise or from the fundamental wise, I just don't see that this is the end of a stronger dollar. And the reason for that is very simple. Even though we know that we're getting the commitment from the Bank of Japan that there's no more hike potentially by the end of this year, the interest rate gap in between the USD dollar and the Japanese yen is set to narrow down. We're expecting a 1 full % cut by the Fed. So by the end of this year, we're going to see that the interest gap will narrow down to 4% and even much lower to 2025. And if we're looking back to a bit of the history, when the last time the interest gap in between the USD and JPY was sitting at 4% or even lower, that will bring us back into November 2022, and even further is 2018, 2019. And back then, if we're looking at the exchange rate layer, back into November 2022, the exchange rate in between USD JPY is about 140 or even lower than 140. And even further than that, 180 at 2018, 2019 is below 120. So by today's standard, which is sitting roughly about 146 now, I do see that there's quite large potential for a stronger yen to coming back on the table.
And do you think the bull market in the equity market in Japan can withstand a stronger yen at this point? Or do you think this also turns the page on what's really been a fantastic several few years for Japanese equity investors?
Yes, I do see quite a big risk there. Even that we have seen quite a strong recovery in the Japanese equity. But if you're looking for the technical wise, that the market wise still quite hovering around the correction zone. We still see having the Japanese, for example, Nikkei 2025 still trading about 10 to 15% below its all-time peak. So in that sense, I think we do see a coming back of the appetite for that. But because what happened in the past, I think the scar will definitely left there. There's still a shadow. They will take time to heal for the Japanese equity. And what the journey ahead, as we mentioned about a stronger yen, will definitely the biggest threat to this recovery journey. And I trust that will be quite bumpy ahead.
And Hebe, Dave mentioned also the sell-off in AI and tech stocks. You seem to think it's overdone, and you're looking for inflection points. What are going to be those triggers for those inflection points?
Yes, I do believe it's overdone in terms of if you're looking for the valuation. Even that the AI stock has rallied quite strongly last night. If you're looking for for example, Nvidia's, especially Amazon's valuation, they're still trading below their 5-year average. Amazon is quite worse, about 40% discount to its 5-year average, the PE ratio-wise. And often when we're having the stock trading at a lower valuation, it's because outlook isn't that good. But if you're looking back into the quarterly report, either from the whole AI chips demand for that, that's definitely not the case. And so I do expect the turning points. One is that will be probably in 2 weeks' time when we're having the Nvidia's quarterly earning report will definitely show us a more updated picture about what's the demand there, what is there, any other potentials, keep pushing that up. On the other hand, is a bit further down there, we often know that a rate cut journey, if we started in September, will often increase the appetite for the growth stock, will increase the business confident to keep investment into that. So I think that turning point will be pretty soon. And I do believe the AI stock is overdone at today's valuation.
Hebe, thank you so much for the time and the insights, of course. Market analyst, or Hebe Chen, market analyst at IG. We're just getting the midpoint of the day out of the PBOC 714.15 against the US dollar. Context is key here, certainly, when you look at the dollar China over the last 2 days or so. Folding in, of course, a reaction to the fairly cooperative, is that way good with it? The PPI numbers overnight, we went from 718.50 thereabouts here to the current level. So there is some dollar weakness that we have to sort of bake into the conversations today.
Coming up next, a pretty big story. The US DOJ said to be considering a breakup of Google after a landmark ruling found the tech giant monopolizing the online search market. We're counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. This is the China Show.
Welcome back to watching the China Show. The big story, of course, that we woke up to as well here is this Bloomberg scoop that the DOJ is actually weighing a breakup of Google. And as you can see, of course, shares of Alphabet trading weaker in the after-hours session. Let's get the details of the story. And our tech reporter, Belle, is here with us, of course, to talk us through what more are we learning here from sources.
Yeah, so this is the sort of follow-on here, because last week we had the ruling that was the liability decision that the US judge made that Alphabet or Google had illegally monopolized the internet search market. Now we're moving to, okay, what's the solution to this ruling that's been in place? And so the DOJ, or the Department of Justice, needs to essentially present I guess, a proposal to the judge in the case here for how the issues need to be solved. And so what we're hearing from sources is that the DOJ is looking at a range of different options, but essentially they could push for Alphabet to be broken up. That's really significant because we haven't seen any sort of company in this sort of situation since Microsoft going back 2 decades ago, and that attempt was unsuccessful. But what they're looking at here is a range of different units that could be divested. So there's the Android operating system, that's on around 2.5 billion devices worldwide. There's Google's web browser Chrome, that could also be forced to be sold as well. Or there's also the sale possibly of AdWorks, and that's the platform that Alphabet uses to sell text advertising.
That's certainly some of the things we're highlighting. Are there less severe options that they're looking at as well?
Yes. So going back to this ruling that was made last week by the US judge, essentially what was found was that Alphabet had, or Google had, put these contracts in place where they were essentially paying billions of dollars to companies like Alphabet, like Samsung, or rather Apple, but to make Google the default internet browser on different devices. Those sorts of contracts were found to be illegal because they essentially created a monopoly where it was impossible for other companies to operate. And so the judge in this case could be asked to prohibit Alphabet from signing those kinds of agreements.
Okay. Timeline, and what does this mean for the broader industry?
So timeline here really depends on where we get with the possible appeal. Alphabet, we know, is going to be appealing this decision. If they're allowed to appeal it before the remedy discussion, it possibly kicks the whole thing down the road by 1 to 2 years. If they're not allowed to appeal the decision before remedy discussion, we're talking about this happening within the next few weeks, months. The question, of course, is really important for the broader tech sector, who's going to be watching very closely. Can antitrust enforcers really use the existing antitrust laws in this kind of scenario, given that some of them are more than a century old?
All right, Annabelle, thank you. Annabelle Jewelers there with the latest when it comes to that Bloomberg scoop on Google. We got some breaking news. Some local media in Japan. This is Kyodo News that's reporting now that the Prime Minister Fumio Kishida intends not to run for party leadership. So certainly that would be some big news here, deciding not to run for that LDP presidential election. So that certainly is when we're watching out for here today. But yes, what does this mean, really, for Japan?
Yeah, and he assumed office, what, late 2021, of course, and fairly quick. The details so far is what we've told you, and once we do have a deeper understanding of what's going on, we will bring it to you as well. But in case you missed it, there we go. Yeah, the Japanese Prime Minister, based on a Kyodo report, has decided not to run in these upcoming presidential elections within, of course, the LDP party. Right, we'll get you a full preview of the trading day ahead as we approach the opening bell in Hong Kong, in Shanghai, and Shenzhen. 6 minutes away, you're watching The China Show. Welcome back to shows. We're up 5 straight days going into this morning on the Hang Seng Index, and we are poised for maybe a 6-day. Certainly we are poised for a higher open, whether or not we close at these levels. So we are putting together some decent momentum ahead of really arguably the biggest of the biggest in terms of material importance and not just waiting, of course, in terms of the companies reporting. Tencent Music, by the way, we'll show you that in a moment there, and AlibabaGD.com, of course. But ahead of that, we are looking at a higher open this Wednesday.
Yeah, Tencent Music is actually in those analyst actions today, at least for the ADRs are concerned. Cut to neutral at Daiwa. That's soft paying users data. And really what they're seeing is social entertainment that missed estimates. That was really what disappointed the market as well. So we'll watch how that fares in Hong Kong. Another call from SMIC, 8 shares rated a new buy at ABC International as well. Stocks in focus, talk about Tencent earnings. Tencent Music is doing this in Hong Kong right now and really kind of seeing that filter through. And the 8 shares were down 7.5%. The open is next. Welcome back. You're watching The China Show. We're counting on the open of markets here, and certainly there seems to be some optimism leading up to this US CPI print here today after what we saw from the PPI prices overnight. So that's helping at least for really equities to catch a bid here this morning, but it's modestly higher in the pre-market for the Hang Seng. And watching still that renminbi strength. 714 levels or so. So we broke below that 715 handle on the back of this dollar weakness too, Dave.
Yeah, we certainly need to thank the PPI print, which came out overnight. We went from 718 and change to the current levels on dollar China. And, we could actually even go further depending on what the CPI print looks like later today. Now, ahead of the open, as Yvonne is pointing out, there is some momentum coming through as well across the equity complex in the Asia Pacific. So we're up 4 days on the benchmark. We were up 5 on the Hang Seng Index. We could see number 6 today. Apart from what's taking place, of course, onshore, and I'll show you a chart later on in terms of turnover, because that's really, really gone away as far as activity numbers, trading activity is concerned there. You're looking at a 10 and 30-year yield, so we are seeing a rally again for a second day after that melt-up we had, of course, going into the session yesterday. To mention as well, today's a big, I guess in some ways, litmus test for what appetite is looking like for bonds, because we have a bond auction today. We have 1, 3, 7, I'm just trying to remember, and 20-year bonds later today. All in all, 400 billion renminbi. Thank you so much for that. Flip the boards, please. The open in Hong Kong, we talked about 5 days. We are getting day 6, as you can see on your screens. This company reports later today. More a preview of that in just a moment. That being said, of course, Tencent Music reported yesterday. That's coming up very, very shortly on your screens. They had a 15% drop in the stock overnight. In the pre-markets, we were down 7.5%. You should see that come up on your screens as well. A couple of other big companies are reporting today. CK Infrastructure, Gore Tech, and Power Assets are set to report today. And also speaking of, 20% now on Tencent Music. Speaking of a company that reported too, WH Group, there we go. 5% up to the upside. The guidance, though, as far as where they think pork price is going, that's a fairly big player, of course, in the industry. I mean, keep in mind, from the broader economic perspective, we did get the inflation print, which came out on the higher side of things. A lot of that was the pork price, right? This pickup. They actually think pork prices will start to moderate from here. What does it mean for the broader inflation conversation? Right. We alluded to this earlier on, this sort of diverging path we've seen in the onshore and offshore markets. So let me start things off here with, as promised, the Hang Seng Index. Yesterday closed above the 200-day moving average. Some of your technical indicators, number one. Number two is your RSI, for example, showing that momentum is starting to pick up ahead of major earnings. That's the Hong Kong story. The onshore story is, and this is something we've been tracking this week so far, lower and lower as far as stock turnover is concerned. So you combine everything, Shanghai and Shenzhen, and as of the close yesterday, the amount of turnover we saw there was the lowest going all the way back, and we have the next chart, there we go, to pre-pandemic levels. So it's certainly one of the good conversation points, I guess, Yvonne, we could talk about with our next guest in the top of the next hour, I believe.
Yeah, KraneShare's Xiaolin Chen, she's going to be joining us a little bit later on. She still thinks Chinese assets could be attractive when it comes to diversification. She was really watching that sell-off in Japanese shares and saying, look, you saw where the flows are going, and China seemed to be that place to kind of seek shelter at that time. We'll see if that continues. We're looking at shares of Tencent as well to wait to the release of those earnings here. It looks like it's going to be a decent set of numbers, just given what we've been seeing in games, short videos, the like here. Also some anticipation of some sort of buyback or dividend program as well. Let's bring in our Asia editor, Edwin Chen, with more on this. What are you expecting, Edwin?
I think you're right. We are expecting the numbers to be strong. It may be a case where the market expects a robust set of numbers, and it reports something that's not strong enough. But we'll see in a second. I think what we're expecting is evidence of what we like to think of as a bit of a gaming renaissance in China. Tencent and its industry, we think, has been through a number of years of pretty. It's been a hard slog, shall we say, for a number of years with regulatory scrutiny and consumer sentiment waning. But this summer, I think we've seen, several, shall we say, big game smashes.
Yeah.
Like really successful debuts, including Tencent's own Dungeon and Fighter. So I think for the first time in perhaps quite a long time, the industry is looking more upbeat than it has.
Turned a corner, right? So you have Tencent, you have a couple of big ones coming through as well. Before we talk about the others and what it means for the industry, buybacks have been something that investors have latched onto while we've gone through the soft patch.
Oh yeah, Tencent by far is the biggest stock repurchaser, at least in Hong Kong.
Okay.
And it's been consistently ranked at the top of that chart. And I think what Tencent executives are trying to signal is the fact that they think, first of all, that their company is undervalued, and also that they are squarely focused on investor returns. So it's been a good strategy for them over the years, and they have maintained their position as China's most valuable company, partly because of that, but not entirely. I mean, again, in the past few months, we've seen quite a strong run-up in the stock because of gaming.
Yeah. And what do you think is going to tell us about Tencent's broader industry or the state of the consumer in China? Because it seems like Tencent, as we talked to some guests, they're a bit more isolated from this macro weakness compared to some of these e-commerce players.
Yeah, gaming's an interesting one. I mean, we saw it surge during COVID, and we saw a bit of a slump post-COVID. But in many ways, when consumer spending is bad, gaming spending can still be strong. I think we've seen this time and time again, not just in China, but elsewhere in the world. So a lot does depend on buzz and excitement and ecosystem and kind of a lot of unquantifiable factors. In Tencent's case, again, going back to DNF, Dungeon and Fighter Mobile, It's important not just because it seems to have revitalized gaming spending, at least, even in a weak consumer environment, but also in the longer term, Tencent needed something to show as a growth story apart from Peacekeeper Elite and Honor of Kings.
Edwin, thank you so much. With a preview there of a very important set of numbers coming through, not just for the company, but also for the broader sector. Edwin Chan there. Just to recap the breaking news out of Japan, just of these last few minutes or so, very consequential this. According to Kyodo News, the Japanese Prime Minister will not be running for the party leadership in the next upcoming elections, which effectively could mean, of course, he is stepping down if and when at that point in time. There will be a press briefing taking place within the next hour or so. The timeline we're getting right now is 11:30 a.m. Japan time, so that's about an hour from now. That's also according to Kyodo News. We'll keep you abreast, of course, of all this taking place. NHK also coming in and saying that the Prime Minister intends not to run for party leader.
Yeah, more from this Kyodo story for a little bit too, saying that it seems like he has lost support within the party, and that's why he has given up on this re-election. But yes, this basically means the Kishida administration comes to an end after just under 3 years. And so, yeah, we're waiting to see who the successor might be for the LDP. We're going to get Isabel Reynolds on this story coming up as well. In terms of what we're checking out for other corporate stories today, Australia's securities regulator is suing the ASX for allegedly misleading statements relating to upgrades of its clearing and settlement system. ASIC says that exchange's claim in February that changes under its so-called CHESS project were progressing well were not actually true. The ASX CEO Helen Lofthouse says the company recognizes the serious nature of these proceedings, with cooperated fully with ASIC's investigation. U.S. advisory firm Alvarez & Marsal plans to boost its Australian headcount by more than half on expectations more firms will run into financial difficulties. The company sees rising interest rates adding to stress at firms, and A&M is looking to employ 500 people by the middle of next year across businesses including financial due diligence, performance improvement, and tax. Bloomberg has learned that BHP has resumed wage talks with union leaders in Chile in a bid to end a strike at the world's biggest copper mine. Sources say the main union at Escondida has agreed to BHP's request to revisit sticking points that prevented an earlier deal. Striking miners warn they have enough funding for a long period. And Starbucks shares jumped after the firm ousted its CEO, Laxman Narasimhan, who had hired Chipotle's Brian Niccol as its next leader. Niccol starts his new role next month, and the shakeup comes after activist investors amassed stakes in the company. Narasimhan's abrupt exit adds to a record number of CEO departures from U.S. companies.
Yeah, and this shakeup does come as the company also looks to India amid the slump in sales in some of its major markets like the U.S. and China. We've been talking about this. The Tata Starbucks CEO, Sushant Das, actually spoke with us about their strategy to boost growth in a market dominated by, well, let's face it, tea drinkers.
It's about category creation. You know, today we are a tea drinking nation. Tea penetration is 91%, 93%. Coffee penetration is 14, 15%. Even amongst the affluent class, right, maybe the kind that we are targeting, coffee penetration is 25%. It is 18 million people. I want to grow that, because if I have to grow and I have to open 1,000 stores, the big thing is that I need to increase the category, right? That is what I am. So it is about category creation. To make category creation, you need to ensure that people are comfortable coming into a Starbucks. Today, people come to a Starbucks because of an occasion, because they are meeting friends, because there is an office meeting. You need to convert it into a habit. That's what will give us, that is what will help us to grow Starbucks, the brand, and us as a business.
Average revenue has to increase per customer.
In India, it is about volumes, and that is where I was coming to, which is why, if you look at it, we realized, for example, in a group, today, if you're going out from office, let's say there are 6, 7 of you, 4 of them say, okay, let's go to a Starbucks. 2 people might say, hey, I don't drink coffee. You know, let's go to a place which serves both tea and coffee, right? So we launched, so today we have Masala Chai, we have Elaichi Chai, we have filter coffee. Similarly, we heard, let's say, we realized that, let's say, couples, right? Or the husband, wife, they will come during the weekday, But during weekends, we realized that they don't come to our store. And when we went and asked them why you don't come to our store, we realized people saying, we have kids. So we want to go to places, and as Indians, we don't serve tea and coffee to kids, right? It's an adult drink. So we launched milkshakes, which maybe doesn't exist in other markets. And we have now seen that, so their families can then come in to a Starbucks. So those are things that you need to do for India specific. And more so as you go into, markets where the category penetration is lower. Because you need people to come to the store and then they will discover. Then our partners will take over. It's about their experience. It's about the ambience. And I think that's where food plays a big role, right? In India, again, unlike the West, even at home, when you have your cup of tea, you will always have a biscuit or you will have a snacks, right? We never give a beverage by itself. We always give people a snack along with it. So food attachment for us, to answer your other question, is high.
What would be the mix right now between food and...
I'll share that with you.
And how much is food increased?
So food is around 20% of a mix. Beverages is around 80%. It's not around 80%, it will be around 70-75%. The rest would be, your at-home coffee, merchandise and stuff like that.
And that's higher than the global average?
I think so, in terms of the food. And one of the things that we realized in India when it comes to food is there is a preference for local taste flavors. But obviously, you don't come to a Starbucks to have vada pav or to have your samosa. And we will also not match up to the guy who is doing it. He will do a better job. That's not my core competency. So the idea is to give flavors, local flavors, but do it in a format which is Starbucks. So each market, now we have gone to the extent of localizing, and I think that's the other part of the story, India growth story. You cannot treat India as one.
And that was Tata Starbucks CEO Sushant Dash there speaking with Advid Palupu. And yeah, we're still sticking on to that breaking news that we got out of Japan.
Yeah, this concerns, of course, the Japanese Prime Minister and all the news coming through Kyodo. NHK also reporting the same, that the Prime Minister Kishida will not be running for re-election at the upcoming LDP race. He is taking responsibility for the political funds issue. That's what we know so far, and will, in fact, right after the short break, do not go away. We'll be taking straight to Japan for the latest on this breaking news story. Keep it here. You're watching Bloomberg.
Back to the breaking news that we got this hour. Japanese Prime Minister Fumio Kishida is reportedly not intending to run for re-election as leader of the ruling Liberal Democratic Party. And he's set to brief the media in the next hour or so. Let's bring in our Tokyo Bureau Chief, Isabel Reynolds, on this developing story. And Isabel, it's interesting. We're just about a month away from this election as well. And we see this news. What ultimately led to this decision, you think?
Yes, well, I mean, Kishida came in as a relatively popular prime minister just under 3 years ago. That reputation as popular as quickly was dispelled by a huge range of scandals, starting with one triggered by the assassination of one of his predecessors, Prime Minister Abe, which led to sort of revelations about the connections between the ruling Liberal Democratic Party and a fringe religion. That was followed by financial scandal after financial scandal, and he hasn't really been able to restore his popularity since those broke out. So Kyodo News is reporting at the moment that he's resigning to take responsibility for those scandals.
So Isabel, take us through the next logical steps here. What are we watching out for as far as future developments are concerned short term? Right. Well, we're going to see him today give a press briefing. We're not sure how long that will be and what exactly he'll discuss, apart from his intention, presumably, not to run. Then we're going to see the race will start sometime in September. There's been some discussion about how exactly the race will be run this time. They can change the rules within the party, exactly how they run it. And then we'll see of course, the candidates start to come forward. If we look at the polls that have been held, the public opinion polls, the most popular option at the moment is former Defense Minister Shigeru Ishiba. But he may lack the support within the party and the parliamentary party in particular.
Other options are Kono Taro, who's currently the digital minister. He's another option who is quite popular with the public. And a third one is Koizumi, who's the son of a former prime minister and also quite popular with the public. But at the moment, the race is completely open. We don't know exactly who will be able to run. You have to get 20 people to back you within the party to be able to put your name forward as a potential leader.
Yeah, Isabel, and this might almost be bordering on speculation, but this is, of course, an election within the LDP itself. And I'm wondering, the names that you mentioned, people are going to start wondering, will there be major policy differences between these people, or will it be business as usual?
That's a very interesting question. I mean, until a few weeks ago, I might have said that potentially there would be more pressure on the Bank of Japan to change its policy. But we've seen what's happened since the first rate hike that the Bank of Japan made. So it may be that those candidates who've come forward and said, oh, I'm going to pressure the Bank of Japan, or indicated that they have a different opinion on monetary policy, may not be so keen on that idea now. So even those policies are not exactly clear as of now. But I think, in general, we're still going to be within the same ruling party. The opposition parties don't really have a hope of winning the next general election as of now. So I think we can expect the policy changes to be relatively minor as of now.
Isabel, thank you so much for rushing to set, of course, on very short notice there, breaking news out of Tokyo. Isabel Reynolds, our Tokyo bureau chief, and as Isabel was pointing out, the briefing, of course, takes place in about 40 minutes or so. Plenty more ahead here on the show. This is Bloomberg. Welcome back. You're watching the China show. So in about 9 minutes or so, the RBNZ will tell us whether it's a cut for the first time since the pandemic hit, or is it worth waiting a couple of more weeks? Most economists think, though, that there is a case to be made to sit tight, be patient, maybe even sit pretty. Okay, let's bring in Swati Pandey here, our Bloomberg economy reporter in Sydney, for us to give us a preview of what the arguments are, Swati, both ways here.
Yes, so this is quite an interesting meeting, and there's a lot of excitement around it. There will be a lot of volatility in currency and rates market as well in the lead up. What we are seeing is on the economy side, New Zealand is set for its third recession in less than 2 years. Inflation is coming down, labor market is loosening, unemployment has gone up. So really, some economists are saying that this is the right time for the RBNZ to start cutting interest rates. Otherwise, they will have to go for larger moves, like 50 basis points every 5 basis points. The other side of the argument is that just 3 months ago, when the RBNZ did its monetary policy statement, in the forecasts, they had signaled that a rate cut is not likely until the middle of next year. So this will be a big about face, and such a radical change in stance is likely to question the credibility as well. So would they want to wait a little bit, wait to see what data shows, and then maybe move in the remaining 2 meetings of the year, or whether they decide now is the right time? That's the big question.
Yeah, and what are we likely to hear in terms of this, the press briefing and the statement in particular on the tone, right? We heard from the RBA's Michelle Bullock saying, they did actually talk about some of the external risks out there. Market volatility is certainly one thing that discussed here that may, impact their, decision making in some way. I mean, are we likely to hear that from the RBNZ too?
So this is a monetary policy statement, which means we will get fresh forecasts on the outlook for economy, inflation, employment, as well as some sort of a dot plot on their forecast for where they see the official cash rate. So this is kind of like a more detailed analysis of where they see the economy heading over the next few years. There's also a press conference with Adrian Orr. So definitely they will be talking about a lot of global factors. They will be talking about this market volatility, global easing cycle that we are kind of seeing has already begun. So there will be a lot of wholesome discussion and a lot for markets and economists to digest.
Swati, thank you, Swati Penny there, our economy reporter joining us out of Sydney as we count down just a minutes away from that RBNZ decision. Right now. Another check for the markets here. Of course, the big news here this hour has been what we've been hearing from Japan, where the Prime Minister Fumio Kishida is not seeking a second term, according to multiple reports that we're hearing out of Japan here this morning. This equity rally, though, still continues for a third day for Japan. We're seeing the topics up about 1.5%. Dollar yen, I think we've reversed some of the weakness, though. We're back below 147 levels now to 146 or so. And we're watching very closely some earnings, obviously, to tell you about Sino Biopharma, Foxconn Industrial, Tencent Music. Wow, we're down still some 18% after, the earnings were actually decent, but I think there was some soft user data numbers in terms of entertainment that did disappoint the market. Tencent is really up next, the one to watch, where shares are down 1.5%. This is Bloomberg. Welcome back to the China Show. Here's a look at the HSI a half hour into the session. So we basically had to reverse those early gains, and we're seeing a bit of downside here, about a fifth of 1%. So we are losing momentum. We talk about this divergence between the 8 shares as well as what we've been seeing onshore, where turnover has been very weak of late, can really bring us back to those pre-pandemic levels, and we're just seconds away from that RBNZ decision, Dave.
Yeah, keep in mind we're sitting at 5.5% on the cash rate. They haven't moved on rates. The debate right now, there's a sizable minority that actually think it's time, the window is ripe for the RBNZ to jump through and deliver that first rate cuts since the pandemic hit in 2020. There is, though, the majority still think there is, patience is still a virtue at this point in time. Kiwi dollar on bottom of your screen, that's going to move, of course, very quickly. Doesn't really matter what the RBNZ does. It's quite sizable. And here we are. Oh, okay. It's looking like they did cut interest rates. Let me just confirm that for you. Yep, there we go. The RBNZ has cut interest rates by 25 basis points to 5.25%. Most economists did see no change there.
Yes. So this is a bit of a surprise, I guess. We talked about how close it was. There was, I think, 9 economists out of the 23 that we surveyed that said it is time for the RBNZ to pivot, just given how momentum is really cool when it comes to inflation. Growth has really slowed for the past year or so. So there you go. You see the Kiwi dropping like a rock here this morning. Also talking a little more about where they see the average official cash rate in the first quarter of next year at 4.62%, and then following all the way to the third quarter of next year, 4.1%. So they are projecting multiple cuts in the future, too.
All the way to that point. That's a good point, Yvonne. 4.1% third quarter of next year, effectively about 100 basis points lower from the current levels into the middle of next year. So what isn't clear, though, is from the current level. No, okay, so it's 25 today, and then 100 more basis points, roughly, based on the current projection. Wow, okay, something for the doves today. And that's ahead, of course, of US CPI print later today. Do we get further momentum coming through? By the way, we'll be hearing from the RBNZ Governor Adrian Orr, joining us, of course, tomorrow. Keep in mind he'll be joining us to give his thoughts on really why they cut, why they chose now, why the outlook. They have an inflation forecast, annual CPI returning to within the target band. So stay tuned, of course, for that on those times on your screens right now.
Yeah, we're still getting a little bit more on terms of from this policy statement. So the committee reached a consensus on this rate decision. They also forecast show recession in the second and third quarters of 2024. So certainly that's something that may have driven to this decision here today to cut by 25 basis points. To slow down the economy certainly has been that concern. Let's bring in our MLI strategist, Mark Cranfield, joining us now. I mean, it was a pretty split decision, toss up here, Mark. But it's interesting how dovish these comments are, and in terms of what they're forecasting in terms of cuts for the rest of the year. What's your take?
Yeah, indeed, that's what the swaps market was indicating before the decision came out. If you look at where the 2-year interest rate swaps were sitting, it was something like 160 basis points below the cash rate, which is a huge margin. The traders need to be very, very confident that there's going to be a dovish outlook. And that's pretty much what they've been given, the idea that the RBNZ does see rates getting close to 4% sometime next year, pretty much justifies where the traders were going. Even so, with a lot priced in, there might be room for a little bit of pullback on rates here. But for the Kiwi dollar itself, it's a particularly negative outlook. That for foreign exchange traders, it's probably even more dovish than they were going for. Probably helps the equity market to some extent. There'll be relief there. But certainly, most swap traders here were hoping for a dovish outlook, and that's exactly what they've got.
Yeah, Mark, we've been talking on the show a lot about, the RBNZ bigger context here is, they tend to be one of the first, of course, to go into cycles, come out of cycles as well. What does this tell you about where we're headed as far as G10 central banks, ex-Japan, are concerned here?
Well, yeah, for once, they're not leading the G10 cycle, as you're quite right. I mean, in the past, they have been one of the leaders, whether it's raising rates or lowering rates. But of course, the European Central Bank have already beaten them to it, and the Bank of England as well. We're actually waiting for the Fed. It's an unusual situation this time around where the Federal Reserve is actually lagging behind. Even the Swiss have lowered interest rates in this cycle. So this time around, it's the Fed that's holding back. But of course, now, particularly after yesterday's PPI report and with the CPI to come, people fully expect the Federal Reserve to do their part as well. But clearly, there's no point in fighting against this trend. Rates are going down. Inflation globally is on a pretty decent downward path. The Bank of Japan is the outlier here. They're the only ones who look as though they could raise interest rates again. So what New Zealand is doing is just pushing them in line. It's interesting, of course, they're ahead of the Reserve Bank of Australia. It probably doesn't change the outlook at all in Australia. They seem pretty steadfast on their idea that inflation is a bit more sticky there. But the fact that the RBNZ even mentioned recession clearly shows that the two countries are out of step, and New Zealand needs to get on with it. They may even cut again before the RBA even does one rate cut.
And this brings us kind of a good, perfect setup for the US CPI print, which is the next hurdle for this market. I mean, the market reaction was basically to continue on with this bond rally. You buy tech stocks and you sell the dollar. Mark, I mean, is there a number that you're looking for tonight that could actually keep this risk rally going?
I think in this kind of mood, I think traders will accept an inline number, providing the core number doesn't pop up. I think that would be the only thing that could damage the mood in the market at the moment is if the core CPI number was higher than expectations. If it comes in the same or like PPI slightly below, traders will be very, very happy. You can see the reaction in the bond market yesterday. Clearly, they just want to believe that interest rates are going to go down. They're going to go down hard. It's going to start pretty soon. And there's still some people out there that think there's more of a risk of a hard landing than a soft landing in the US, even though the Federal Reserve is pushing back a little bit on that idea. But if we get a very soft CPI number, that will be back on the table. People will be thinking that 50 basis points is necessary in September, even though the Federal Reserve would much prefer to only do 25 and do it gradually. But that might not be something they can control. And there's still one more CPI report to come after this. So there's a lot weighing on this. Whatever happens, whatever the number is, there will be volatility after tonight's report.
Yeah, not to mention Jackson Hole too, Mark. Mark, the news we weren't expecting today came out of Tokyo, and the Prime Minister is, effectively choosing not to run again and effectively stepping down. We'll get more on that in a moment. But how are you wrapping your head around the news here from a market's perspective? What does this mean for the bull market, for dollar yen?
If anything, it's a marginal positive for equities in Japan. I mean, the ratings of the whole Japanese cabinet have not been very good. They're a little bit weighing on sentiment towards Japan. So if you remove that factor, if people now see a slightly clearer path for the leadership of the LDP, eventually they've got to call elections not too far away. So if they get a little bit of respite from the public in that respect, that's a slight positive for equity. It doesn't really mean a great deal for the Japanese yen. That's in the context of what the FOMC and the BOJ are doing. And the path for that is probably a little bit lower anyway, regardless of what happens with Japanese politics. But if you're looking for somewhere where there's a target, and maybe Japanese yields can push a bit higher as well, because whoever takes over will probably need to promise increased spending in Japan, and that's not good for the Japanese bond market. So, yeah, yields a bit higher, maybe stocks a bit higher, not much for the yen, really.
Mark. Thank you, Mark Cranfield there, MLive strategist joining us out of Singapore. For more, of course, on the Japan story and the fact that Kishida reportedly not seeking that second term, let's bring in our Asia trade co-anchor, Sherry An, in Tokyo. With the latest, and Sherry, just talk us through how big of a surprise is this news?
Yeah, I mean, Mark was talking about the Japanese yen and the direction of the BOJ. Aside from those 2 points, really, this was the biggest question of the summer here in Japan. And the fact is that, as alluded earlier, we have seen this hesitation about his government, given the lowest support rates for Kishida since he took office back in October of 2021. So we have heard from rivals really signaling that they were hoping to challenge him soon. And we also saw that when he was being asked in the last few weeks by media whether he would run in the September race, he really avoided a direct answer. But then this week, we heard from political heavyweight Taro Aso. He's, of course, a vice president of the ruling LDP, has held so many different cabinet positions. He was really backing his political effectiveness and record by the prime minister. So we were thinking, what does this mean? Could he run again? Well, we'll know in about half an hour, because we're hearing from local media that Prime Minister Kishida will be addressing the press.
Yeah, and Sherry, this one in particular, the news right now, is being attributed to a political funding issue. So put this into context for us, that the funding issue plus the other setbacks that Kishida has had in recent years.
Yeah, slush fund scandal, as you say, David, was one of the issues that the Prime Minister had that had angered the public here in Japan. His handling of party members really failing to record their income. So that had become a big issue across society. But also, as we're talking about the Japanese yen, as we're talking about the BOJ, it's really been about inflation, right? I mean, this could have a really positive macroeconomic implications for the Japanese public. It just means that their yen is not going as far, that really they're feeling poorer and poorer. So price pressures were a big part of the issue that a lot of Japanese people alluded to. And we got some indications of where the support level for the Prime Minister himself, for the LDP, was when the LDP lost that special election back in April, which Kishida had described as part of a judgment on himself, winning only 2 of 9 seats in special elections for Tokyo's Municipal Assembly. And we know that the LDP has really ruled Japan almost without interruption since its formation back in the 1950s. But we'll continue to watch where the direction of public sentiment goes from here, especially in that vote that we're expecting for late September. We have seen more voter-friendly measures come out of the LDP, such as tax rebates, additional utility subsidies, but that really failing to revive public approval so far.
And Sherry, who are the likely candidates? I know there's some popular choices out there right now.
Yeah, right now, former Defense Minister Shigeru Ishiba has been really talked about a lot. Local media saying that he is actually planning to run for the election in late September. We have heard that he might be also a popular choice in local media surveys. We have also had a Digital Minister Kono Taro, for example, on BTV, and I asked him if he wanted to run in September. He did not confirm it, but he did say that he wanted to become Prime Minister at some point because he could pursue his policies. Economic Security Minister Sanae Takaichi, former Communications Minister Seiko Noda, also being talked about. Of course, we will really be watching some of those names put in the ring, but at the same time, they will be facing a very difficult backdrop, right? I mean, we are talking about really trying to orchestrate a very difficult and tricky normalization of Bank of Japan policies and an economic revival that still there's a lot of skepticism whether or not this is really sustainable. David?
Yeah, Sherry, thank you so much. Sherry An, our Asia trade co-anchor in Tokyo for us. Don't go home, by the way. It's going to be very busy this morning. Stay put. As Sherry was pointing out, in about 18 minutes or so, local news is reporting we are set to get, of course, Prime Minister Kishida set to speak in briefing media. Stay tuned for that. Markets are still bid. We're coming off highs a little bit, 0.7% on the regional benchmark. We're now flat on the Nikkei. The rest of the region, they're providing that added push. As far as Chinese markets go, we've effectively reversed the earlier gains. And the other big piece of news, which took place just this hour, RBNZ, in case you missed it, has cut interest rates 25 basis points when most economists were expecting them to stay put.
Yep, and coming up, we're looking ahead to Tencent earnings and how its gaming business might have given the bottom line a bit of a boost here. We're talking a little bit more about that gaming renaissance. This is Bloomberg. Yep, we've been checking these Chinese markets. We talked about, basically we lost momentum in just about, less than an hour into the trade here. And really, this chart really shows how weak market sentiment is right now. You take a look in terms of stock turnover, that basically has tanked this summer. And you take a look at where the value of those shares are basically traded, dropping to levels that we haven't seen basically since May of 2020, right when before the pandemic started. So certainly it is a choppy market out there. It seems like there's a lot of questions about what's next, what are going to be the catalysts. Let's get to our guest, Xiaolin Chen, head of international at KraneShare. She joins us from Harbin this morning. Xiaolin, it's great to get you on the same, at least, time zone, at least, for once. It seems like this market is just rife with pessimism right now. Do you think it's gone too far where we're seeing signs of a bottom in terms of how weak this market sentiment is, or is there going to be more selling?
I'm afraid it may take some time to recover from the sentiments, given the remaining of 4 or 5 months of this year still full of events ahead of us, with US election, with everyone waiting for Fed's decision. Now BOE, and Europe, COB also all acts, on all these, rate cuts. I think China is now waiting. I think in some ways they kind of feel like Fed will cut as well. So they kind of act a few days ago to cut almost 25 basis points. It's too much volatility ahead. I think everyone is kind of like, I'm going to better wait and, see what is the next. I think the volatility ahead of us still is a lot to expect.
Okay, so what's the advice then? Stay out of the market for the rest of the year, just to build on what you just laid out there?
I mean, it's really, it depends on investors' horizon. If it's really a tactical trade, I think you still would find attractive stocks that is having a great valuation with the overall beta corrections in the market happened over the last few weeks. That might be a good opportunity. If not, depends on your position that you haven't positioned already, should position some that's long-term, you're really positive on those stocks. The near-term creates some volatilities, with a bit of a longer-term strategic allocations. Maybe this is the big question mark is where this leads your horizon to be. If it's still a 3-5 years horizon, I think at this juncture, any corrections in the very cheap valued stocks, if the macro environment continue to be accommodative, I don't see a reason after the macro event settles down that fundamentals shouldn't return to be the key drivers of stocks performance from here. It must be.
Yeah, and maybe can you tell us a little bit more? I mean, I know you watch all these ETF flows, but what have you watched what's going on in the bond market, right? This crackdown that we're seeing from policymakers to try to at least steepen that yield curve and put a floor on CGB yields. Do you think that in some ways is weighing on the equity market as well?
Overall, markets is kind of like all sorts of directions. Yvonne, that's a great question. Also, I'm in China and I'm traveling a lot of cities. At this time, I visit Beijing, Wuhan, and also in Guangzhou. Now I'm in Harbin. It's almost in the southern part of China, center of the China, and now I'm very much northeast of China. I'm very surprised by how, obviously, you could argue this is August. It's the summer holidays. Everyone is out for vacations. It's very crowded. Restaurants are very hard to get tables, and people are all out for dining. I was deliberately walking out, on the streets at 9, 10 p.m. in the evening. Streets are full of young people having dinners outside. I sincerely hope fundamentally investors are feeling a bit better. So let macro events settle, and you really need is really consumer to feel a bit better, to lead this consumption lead. There's a lot of a program going on. I learned on my trip in Harbin, which is tier 2, also tier 3 city, quite as developed as Beijing and Shanghai. There is a subsidizing program. If you trade in your old, like air conditionings, that government will subsidize 10-20%, and then the shop has compromised some discounts. So people are going forward with all those trades. And I'm also surprised with our Harbin is my hometown. It's not as developed. A lot of electrical vehicles on the streets. So I think a lot of things is good. You see it yourself. But I do agree, macro events need to be a bit accommodative. All these policies happening in financial, insurance, real estate, we just need to see a bit of a dust to settle.
Right, and Xiaolin, to highlight, I think that's a very important point to underscore amidst all the negativity out there, that the consumers are still consuming, maybe just because inflation is not running too hot, we're not really seeing it show up in the macro numbers. So my question to you is, if the domestic consumer, if they're going to restaurants, if they're going about their normal consumption activities, why is it not showing up in the earnings?
You mean for the e-commerce earnings, or is in general like possibilities?
Yeah, in general, a lot of the consumption-facing names, whether that's e-commerce, for example, is a good place. Some of the consumer staples, for example, we talk about Mao Tai and these liquor makers a lot. It might be anecdotal, but you're not seeing it in earnings estimates being revised higher.
Yeah, I agree. I think people love bargains. I'm surprised how the prices of going around, shopping around, and how low the prices are here. It's like still I think they're still in the recovery mode. David, to answer your question, very straightforward is they're still not back to the pre-pandemic level. If you ask me, a lot of the shops are having a huge amount of discounts, unheard of. For us, living abroad and come back with buying these, like you buying them in bunches, and they get surprised. So people are shopping, but the shops' margins are still low because they're trying to attract the consumer to come back. I do see all the shops I go. I think they are doing sales everywhere in the shop. Though I'm surprised with the physical shops, David. This may be the trends. A lot of the physical shop actually fills up with shoppers and customers around. I think maybe the bit of a rotation from online to offline actually take off because people don't see each other and they may be enjoying this. And when I'm traveling in Harbin right now, I see actually the shop of having more people than we do in London.
We had a guest yesterday, talking a little bit more about this shift change in value, that now is the time to really start looking at value in this market versus typically people would just pile into growth stocks in China. Are you seeing that in your flows into ETFs and the like here, and does that actually have any sort of lasting power, you think?
This is actually a comment from one of our investors during our quarter review webinar. He's actually a US investor. He actually made the call to say, now I see a lot of growth stocks, potentially if they back on tracking, still offer me the growth trajectory, and still offer me a high dividend pay. So you're absolutely right, Yvonne. In this market, this is a little interesting period that the stocks are transitioning to a very different trends that is, that we used to know in the past. Like even Alibaba start to distribute dividends, aren't they? So a lot of the companies in China are encouraged to distribute high dividends. That's really attractive. I heard some of the high dividends attractive companies listed in the Hong Kong can offer you 5 to 8% dividends. That is quite unprecedented. It's not happening in Chinese stocks in the past. So I do think, yes, regulators are addressing high quality names to be listed publicly. And the other thing I think it should happen is IPO market. China needs to resume the IPO market. Last time when I talked to Bonnie, who is the CEO of Hong Kong Stock Exchange, she said, I met her at Davos, and she told me that they literally have 110 applicants ready to go. Obviously, she's doing her job, needed be, but I really think that is the key. You got to see the market resume to normal. Newcomers are coming, and market can stomach it. I think those are actually the very key to watch in the remaining 4 or 5 months in China.
Chen Xiaolin, thank you so much for your time in Harbin there, usually based out of London, head of international at KraneShare. Right, plenty more ahead here on The China Show.
All right, we are checking when it comes to New Zealand assets here today. A bit of a surprise here when it comes to that statement from the RBNZ. I was talking just about, obviously they've cut for the first time in a while, and also talking about further cuts here, talking maybe about 4.1% for the third quarter of 2025. So there you go. You're seeing the Kiwi dollar continue to look pretty weak here this morning, and we're watching very closely Japanese equity markets, just given the news out of Japan with the Prime Minister Kishida to brief that media in a few minutes about him not seeking that second term. 11:29 a.m. in Tokyo. Japanese markets are heading to that lunch break in just a minute. We're just, I think, a few minutes away from hearing from the Prime Minister Fumio Kishida on the back of this news from local media that he is not seeking a second term. So what does this mean for this election that happens in September? Japanese assets are doing this here right now. You actually see the Nikkei and topics reversing those early gains that we saw here. We're actually in negative territory for Nikkei 225. We're just about 0.5% higher for the topics, and actually seeing some strength playing through into the Japanese currency at 146 levels here right now, Dave.
Yeah, quite suddenly a very busy news day for us.
Yes.
It was very
I thought
quiet.
it was going to be quiet.
Extremely.
And some surprises in Japan and New Zealand.
Yeah, the surprise cut, and as you can see on your screens, right, it's mostly, you know, this would have been more green were it not for the reversal we're seeing in Japan. But all that being said, right, so we are looking, and we are going into the US CPI print with some decent momentum coming through in these equity markets. All things equal, we're up 4 straight days on a regional benchmark. We've pared back, as Yvonne is pointing out, some gains in Japan, some gains in Hong Kong. But certainly, you know, markets here rate cuts, and we are getting more rate cuts coming through as well. Okay, and to the breaking news story that we had earlier on, of course, out of Tokyo, where the Prime Minister said he would, well, the reports were that he would not be seeking re-election in the upcoming LDP elections. Of course, this is taking place over in Japan.
There you go. Live pictures out of Tokyo here right now that you see the Prime Minister waiting to get that official, of course, confirmation that he is going to be stepping down as the party leader of the LDP. This really certainly does raise the stakes here of what's going to come in this election and who is going to take his place for the premier. We talked about some possible sort of names that are being flagged here, but certainly what really ultimately led to this decision, he talked about this political fund scandal that he's taking full responsibility of. And obviously there's been a lot going on in terms of these markets. I mean, equity markets have actually done pretty well during his term, Dave, but the last few weeks of market volatility and this unwinding of this yen carry trade certainly may have impacted some of his support too.
Yeah, you know, our Tokyo bureau chief made a very good comment on, you know, what this might mean for some of the pressure that his people in his party have put on the BOJ to change their tact, and whether or not the gyrations in markets and the circus that the BOJ caused in markets was reality enough to change the view of the BOJ, or did it need more political pressure on the part, of course, of Japan? Here we go. We have some breaking news out of Japan. The Prime Minister has confirmed that he will not run in the upcoming LDP leadership race. That headline just crossing from his briefing taking place over in Tokyo, Yvonne.
Yes, so he says he will not run, and it is now time for the new LDP in this next leadership race. So certainly this is confirming what earlier reports had said. And you know, obviously, we've been talking a little bit more about the support that he has been waning from Prime Minister, not just when it comes to political scandals, but really what's been going on with this pressure from them to really get the BOJ to start hiking rates. You know, you kind of wonder now, given what we've been seeing with this whipsaw in Japanese stocks, this unwinding of this yen carry trade, you know, are they thinking a little bit differently now about urging the central bank to continue this tightening path?
Okay, yeah, and we can put that question right now, what it means for broader BOJ policy, these gyrations we're seeing in the FX markets. And we'll leave you, of course, these are live picks over in Tokyo. We'll revisit this once we get any more significant news coming out of the Prime Minister. In case you missed it, he just announced that he will not be running for the LDP leadership race. On the FX markets and all the other big news we're digesting across these markets the last couple of minutes is RBNZ cut. We're going into a fairly crucial U.S. inflation CPI print. Alvin, head of Asia FX strategy at RBC Capital Markets, joins us now out of Singapore. Alvin, we're struggling what to start off with you. We were supposed to ask you about U.S. inflation, which we will, but I'm guessing news this hour out of Japan and New Zealand might warrant that being pushed forward. Let's start with the RBNZ. Why don't we? We did get a cut. I think you were expecting a cut. Correct me if I'm wrong, but what does it mean for policy moving forward and the Kiwi dollar?
Yes, we were anticipating a cut. The market was not pricing it fully, and thereby you got this reaction in terms of interest rates in New Zealand coming off, and of course the Kiwi dollar coming off on the back of that. But that said, the interest rate market actually had been anticipating quite sizable RBNZ rate cuts over the coming year. So in the broad scheme of things, the start of the RBNZ's easing cycle is not a total surprise for the market, even though today the actual cut itself was a surprise. We do think that for the Kiwi dollar in particular, I think it does set a base to the correction that we've seen in the Aussie-Kiwi cross. And I think going forward, the monetary policy divergence between Australia and New Zealand will help the Aussie-Kiwi cross gradually move higher over time.
Given that they're joining the likes of, the Bank of England, European Central Bank, all these developed markets that have already begun their easing cycles, I'm just wondering, does it actually lend to more strength for the U.S. dollar, given that we haven't really gotten clarity from the Fed yet on when they're going to start cutting?
Yes, absolutely. I think it will eventually. But we will have to see the September FOMC. We are still calling for only a 25 basis point Fed rate cut. The market is pricing in more than that at this point, which we think is wrong. And as the market basically market expectations readjusts to a more moderate pace of Fed rate cuts, we do think that will help support the dollar. And on top of that, over time, as volatility continues to ebb in coming months, the absolute rate differential, which is very large in support of the US dollar, will also reassert itself. So I think that that will lend support to the US dollar in coming months.
Alvin, you mentioned that you're expecting 25. The market has almost a coin toss probability of 25 to 50. I sense there's a trade there. Does it make sense to fade this, to your point, this mispricing in the bond market? Should we fade this dovishness we're seeing?
Yes, I think we should be fading this dovishness. I think that there was clearly an overblown concern about the state of the U.S. economy. I mean, of course, we will be getting the CPI report tonight and then also the retail sales coming up on Thursday. But in our view, the U.S. economy is not in imminent risk of a recession, and thereby there is no need for the Fed to cut so urgently, at the rate of 50 basis points per meeting.
And Alvin, I got to ask you how you're feeling after the week that we had across FX volatility and where we are in terms of this carry trade. What is the outlook now? Do you think, there's multiple banks that said maybe we're towards the tail end of this unwind of the yen carry trade. Do you believe that? Or was that just the tip of the iceberg that we saw last week?
Well, I think that if you look at, say, some of the data that we have about, the positioning in the yen. So, for example, if you look at the CFTC data on yen positioning, the data we have is of last week only, unfortunately. But still, it shows that it's almost gone to zero. The net speculative short positioning in yen has almost gone to zero. Now, it's not positive, so people are not turning bullish on the yen, at least speculators are not turning bullish on the yen at this point. But, in terms of the unwind of the net short, very large net short yen position, it does seem to have gone almost to zero. Our own proprietary RBC positioning data also points to this net short in yen having been cut to just about 15% from the very high levels that they had 1 to 2 months ago. So I think indeed the bulk of this yen carry trade has been unwound. And so going forward, unless volatility comes back in a big way and stays elevated, it's unlikely that the market is going to turn net long the yen in our view.
More broadly, Alvin, I guess given what we had last week and the shift, I guess, in some of the key narratives in the FX market, what do you think is the biggest driver moving forward? What will be the biggest driver in FX? Is it yield or is it haven demand?
I think in the very near term, over the next several days to a week, indeed, it is the big question of whether volatility will continue to ebb. And I think if it does, it will help to revive the carry trade in time. And as I mentioned, I think most of this carry trade has already been unwound. So certainly there's room for it to rebuild, assuming volatility continues to ebb. So I think in the very near term, that is the most important consideration. The second one, indeed, is how the market expectations of Fed easing, particularly in the September meeting, adjust from now. So the next few days is about the bigger question of where is global macro volatility going, continues to drop or it surges again, and over the next month, I think primarily it will be about how the market pricing for the Fed September meeting adjusts. We think it adjusts lower for 25 basis points.
And where are you looking for those trades? Is it still among the G10 space, or are you looking EMFX?
I think in this kind of more uncertain environment, particularly given how turbulent markets were last week, just a few days ago, really, I think cross trades perhaps make more sense. For those who are a bit more concerned about another upsurge in volatility. So, for example, Aussie Kiwi, I think with the start of the RBNZ easing cycle, I think the downside in the Aussie Kiwi cross has been capped for now.
Alvin, anything else we haven't talked about that you think is important, very quickly?
I think the fact is that, the big picture is if indeed the U.S. economy is slowing down, I mean, not necessarily recession, but if it's slowing down, it's not actually positive for Asia at all, certainly not positive for Asian currencies, particularly those highly trade-dependent currencies such as the Korean won or even the Sing dollar. So I'll be very concerned about any further moves in terms of dollar weakness that sees the likes of dollar Korea or dollar Singapore pairs drop further. If indeed the U.S. economy is slowing down, the export cycle in Asia will also turn lower. And that is not a positive picture for Asian currencies over the medium term.
Alvin, thank you so much for your time. Alvin Tan there, head of Asia FX strategy at RBC Capital Markets. We'll take you straight back from Singapore to Tokyo, where, of course, the Japanese Prime Minister is speaking. Ongoing press briefing following that announcement, unexpected announcement, largely, that he won't be running for the LDP leadership race. And anything more that's catching your eye as far as headlines go?
Yeah, it's interesting that you mentioned about there's time for new leadership. Is turn a page on that slush fund matter with my withdrawal, he says, and he's urging candidates to raise their hands to kind of step in. But it's important to do politics that resonate with the public as well. You ask what the impact is going to be on markets. Certainly, it's hard to say at this point, but it's just another sort of, I guess, uncertainty across these markets in Japan after the week that we just saw, whether it's the yen, whether it's this whipsaw in Japanese equities. And, markets certainly don't like that certain fogginess, especially when it comes to the political side of things as well. So we might have to wait until September, maybe, to get a little bit more clarity on that.
Yeah, Invesco was the one quick to drop this note for clients that the uncertainty that Yvonne was just talking about there may weigh on stocks as Kishida steps aside. Although a significant change in policies is not expected, it would have a negative impact on the stock market if the policy trend of promoting individual investments is disrupted. And that's, of course, the initial reaction we're getting here out of this breaking news out of Tokyo this morning.
Yep, coming up, we have a Bloomberg Intelligence report that says tens of millions of Chinese homes have been sold before they're even built. We're going to look closer at the implications of what that means for the embattled property sector. This is Bloomberg. Here's your China brief. A look at what's making headlines in national newspapers this morning. And the PBOC-backed Financial News says short-term speculation in the government bond market is declining. That follows repeated warnings from authorities about risk and an increase in debt issuance. The paper says that long-term yields have risen to, quote, reasonable levels, helping prevent a negative feedback loop between falling yields and weakening expectations for the economy. Meanwhile, the Securities Times is trumpeting positive earnings from large-cap A-share companies, and it says 88 firms have achieved year-on-year growth in net profit, with most of them in the electronics and auto industries.
Yeah, and speaking of auto earnings, a report in the Securities Daily touts progress by Chinese car makers over foreign brands. Now, it says outsiders are facing headwinds in China, lagging behind their local counterparts in tech advancements, including electrification. Now, the article also says that foreign companies' market share may continue to shrink. Right, let's stay on earnings here. We're looking at Tencent out at about just after the close of the cash markets here in Hong Kong later today. So just give or take a couple of hours from now, Tencent is opened higher. We're now trading lower 1.3%. Of course, Bloomberg Intelligence expects the company to report strong numbers, partly driven by momentum in domestic video games business, as Robert Lee, of course, our senior analyst, is here with us to talk us through, of course, what we should be focused in on as this bellwether gives us the lowdown later today.
That's right. All eyes on Tencent. So, as you mentioned, I think the focus from the divisional point of view is going to be on the games business. We've seen the initial stellar success, very strong market uptake on their latest release, DNF Mobile, which is based on some IP licensing from Nexon in Japan. So I think the games is going to be a core focus, and probably that's been a core focus throughout this year, hasn't it? Because if you cast your mind back to earlier in the year, there were actually worries about the domestic games business, the fact that their key franchise titles were really, the demand for those were waning, the market was saturated, and there were growth concerns. And how quickly, sentiment has turned around on that, driven by these new game titles. So I suppose, again, that highlights the point is you're only as good as your next game. If you're in the gaming business, you need to continue delivering this pipeline of titles. So to answer your question, people are going to be looking at the pipeline. How does that look into the rest of the year and into next year, more importantly? For where we see at the moment, the momentum should continue through this year, but then we'll get a normalising of that business and into a slower growth period next year, I think.
Okay. We talk about it, it's almost like a gaming renaissance that we're seeing now. Are we likely to see that this regulatory environment is going to stabilise and be beneficial for Tencent?
Yes, well, new productive forces has been the buzzword of this year, hasn't it? So with the Chinese government's medium to long-term plans looking to the high-tech sector, or develop and grow the high-tech sector, and promote that as a driver of future economic growth, then clearly the government and the regulator these days needs to support its tech stalwarts very closely. So I think the regulatory outlook, should continue to remain stable from here, because that's in the interest of everyone.
The AI story, how does it bleed into the Tencent story?
I think you compare and contrast to the US companies where there have been concerns about lack of monetization and also the, very high amounts they're spending on capex at the moment.
Yeah.
To Tencent's credit, I think they've played the long game on this. They haven't tried to overplay it or overhype it in any way. They're taking a longer-term perspective. So AI was never going to make a meaningful impact on their numbers this year or even into next year. I think they're very well positioned in the long run. For one very quick thing to mention, share buybacks.
Yes.
It's not guaranteed they will announce enhanced share buybacks, but given the backdrop of market volatility at the moment, given the valuations that the China tech sector is trading on, given the very healthy balance sheets and cash generation, there is potential for Tencent and others in the sector to announce enhanced buybacks, but we'll have to wait and see.
All right, Robert. Thank you, Robert Lee there, our Bloomberg Intelligence senior analyst, watching all things Tencent later on today. And also, we have more from Bloomberg Intelligence there, and we're telling you that the Chinese property crisis will probably not be resolved anytime soon. After their latest research, get this, they found at least 48 million unfinished homes have already been sold. That's more than the entire housing stock of Germany, if you want a little bit of context, as of 2021. For more, let's bring in our China property analyst, Christy Hong. Christy, what a fascinating report. How do you think China got to this point?
Right. So I think what's shocking from the data is that sales actually went through the roof during the housing boom.
but completions has been shrinking. It's stuck at around 700 million square meter a year. That's around half of the sales amount. And I think there are two problems here. What is obvious is that there's a funding issues for developers, but what is less known is that there's a construction capacity issue in China. Construction workers has been in decline in China. You're talking about aging population, and the younger generation, they're not interested in getting into a low-pay blue-collar job in construction. And what this is telling us is that even if the central bank is going to throw trillions into the housing sector today to try and help complete homes, this is not something that can be fixed in 1 or 2 years' time. In fact, at the current pace of completion, it is going to take 8 years to complete the unfinished homes.
And, this brings to mind the pre-selling model that not just in China, we see this in many property markets in the world, selling before you build it. But what does this then mean about this pre-sale model in China and whether or not things need to be shaken up and changed?
Yeah, so I think for this to drag on, there would be an ongoing crisis of confidence. Buyers would increasingly shun pre-sale homes and go for second-hand homes. And I think in one way or another, the pre-sales model has to go. And we need better consumer protection in China, not paying 100% for something that might not be delivered. And we actually need, something like the practice in developed economies for buyers to pay in installments according to construction progress, or maybe shift to sales of purely completed homes. And I think this is telling you that Chinese developers' model of rapid earnings growth is completely gone, and they can no longer use the sales proceeds from one project and try to fund investment into new projects.
And what does it tell us about the overall housing market that still struggles to recover? I mean, we saw those May rescue packages. We're not seeing anything in the data to suggest that things are actually turning around just yet.
Yes, so I think I talked about how home buyers, they would increasingly shift to second-hand homes. And then for homeowners that are stuck with these unfinished homes, we see an increasing rates of mortgage boycotts if this is going to drag on for 8 years. And we saw the regulators try to push out funding like from the whitelist to try and help accelerate completions. This is not doing the industry any good in terms of accelerating construction in the industry. And then what we're seeing right now is there's still risks of some developers' projects might never get completed.
Christy, thank you so much. Christy Hung, our Bloomberg Intelligence China property analyst, and I guess this time tomorrow, as a housekeeping note, no pun intended there, we'll be getting the new home prices, property numbers out of China for the month of July. Okay, plenty more ahead here on the show. This is Bloomberg.
All right, I believe that presser in Japan has just wrapped up the last couple of seconds or so from the Prime Minister Fumio Kishida, but therefore, really confirming that he has made his final call on his withdrawal from this race. So he is stepping down, not seeking that second term, really talking a bit more about what he wants from the next leader and really to not hinder the progress on reforms. But there's been a lot of talk about who could possibly succeed him, too.
Yeah, and we've come up with several potential names, of course, that have been talked about here. The words of the Prime Minister himself, raise your hands, of course, ahead of those elections coming through. In terms of markets, Nikkei's reversed all of its gains as much as over 1%. We're trading lower at the lunch break. We've seen a spike in the Nikkei Volatility Index going into where we are right now. And, of course, I think Invesco's come out with a note and saying this uncertainty will probably weigh on markets over the shorter term. That's it from us here on the China Show. Plenty more ahead on Bloomberg. Bloomberg Markets Asia is just ahead.